So what is a mortgage? A mortgage is a loan that is used by purchasers of real property to raise the money to buy real estate, or by existing property owners to raise the money for any purpose, by putting a lien on the property being mortgaged.
What's important to understand is that a loan, sometimes referred to as a promissory note or a note, is not a mortgage, nor is it a deed of trust. It's simply a loan. Once the money is secured for the purchase of a home, the lender of that money should protect the loan. This is where the mortgage or the deed of trust comes into play.
The mortgage or the deed of trust is the document that pledges the property as security for the loan. The mortgage or the deed of trust is recorded as a lien on the property with the county recorder's office.
There are two major differences between a mortgage and a deed of trust. The first is how many parties are involved. The second is what happens in the event that the borrower cannot pay. First, let's look at the number of parties involved. A mortgage has only two parties, the borrower and the lender. A deed of trust, however, has an additional third party called a trustee who holds on to the title of the property until the loan is repaid. If the loan is not repaid, the trustee, oftentimes an escrow company, is responsible for starting the foreclosure process. Secondly, what happens when the borrower cannot pay? That's the major difference between a mortgage and a deed of trust. With a mortgage, if the borrower cannot pay, the foreclosure and the sale of the property must go through the courts. This is known as a judicial foreclosure, and the process involves the lender filing a lawsuit. This can be a costly process for both the borrower and the lender. However, if a deed of trust is used, the courts can be bypassed. This is known as a non-judicial foreclosure, and it's almost always faster and less costly. How the process happens is based on state laws and the terms and procedures laid out in the deed of trust.
Not all states use a deed of trust, but more states are converting because it's better for everyone. You can find the deed of trust state chart in the resources section of our website.
There are several places you can get a mortgage lender, a mortgage broker, a bank, credit union, private party, or family member.
The mortgage industry is a major financial sector in the United States. The federal government created several programs called government-sponsored entities, known as GSEs, to foster mortgage lending, construction, and encourage home ownership.
These GSE investors include the Government National Mortgage Association, called GNMA, the Federal National Mortgage Association, referred to as FNMA, and the Federal Home Loan Mortgage Corporation, known as Freddie Mac.
These agencies issue large warehouse lines of credit to lenders, banks, and credit unions to fund loans monthly. Each GSE has underwriting guidelines that must be followed in order to make the loan sellable. The loans are pooled and sold monthly in order to replenish the warehouse line of credit so the lenders and the banks can continue to write new loans. These GSE loans form about 61% of the mortgage market, leaving 39% to private investment companies. GSE-sponsored loans offer better terms and interest rates for those who qualify, and our trainings are mainly focused on these three GSEs.
GNMA bonds and mortgage-backed securities offer 30 and 15-year fixed and 30-year adjustable rate mortgages for FHA and VA loan programs, while USDA only offers fixed-rate programs. Fannie Mae and Freddie Mac bonds and mortgage-backed securities offer a range of fixed terms and 30-year adjustable rate mortgages for conventional loans. These bonds and mortgage-backed securities are considered pass-through bonds because they continually fund new loans through large warehouse lines of credit with lenders and banks. The loans are pooled and sold to mortgage lenders or other institutions who service the loans. Banks and private investors offer 30 and 15-year fixed and 30-year ARMs for jumbo loans, construction, and conforming loans that don't meet the GSE guidelines, known as non-conforming loans. Banks and investment groups that fund non-conforming loans underwrite independently of conforming GSE loans. A conforming loan amount is below the national conforming loan limit set by the Federal Housing Finance Agency annually. You can find the link to the loan limits on our website under Resources and Conventional Links. To qualify for a GSE backed mortgage, each person is required to pass the 3 C's quality test. First is creditworthiness or credit score. Secondly is collateral, which is the property and the loan to value, known as LTV. And third is capacity, which is the debt to income ratio, commonly called DTI ratio. There are also 3 supplemental factors: the level of loan documentation, the occupancy, which could be owner-occupied, a second home, or non-owner occupied, and third is the property type, either a single-family modular built home, a condo, townhouse, duplex, triplex, fourplex, or a manufactured mobile home.
I'll cover the 3 C's in each loan program in more detail in other videos.
Thank you for watching, and here's how you can help us. First, share us with your network on Facebook, Instagram, Twitter, and YouTube. Secondly, tell your family, friends, and coworkers about us. And lastly, we are publicly funded and need your help keeping our videos free by clicking on the Support tab today. Don't miss the tips and timing video, found only on our website, for all the ways that you can save hundreds of dollars when buying a home.